Welcome to today's Explainer, where we're going to strip away all that confusing industry jargon and completely demystify the absolute foundation of a secure financial plan, term insurance. I'm super thrilled to be your guide today. We're going to dive into the facts, break down the numbers, and figure out exactly how you can protect the wealth you are working so incredibly hard to build. You work hard, you save diligently, maybe you even invest a little on the side to build a secure future, right? But here's a thought that most people just completely overlook. What happens to that financial plan and your family's future if you aren't around to see it through? It's not a fun question to ask, I know, but it is absolutely the most important one to answer.
So, to answer that, we've got 4 essential pillars to cover today. We're going to look at what term insurance actually is, why you need it, how to customize it with add-ons, and finally, the critical timing of exactly when to buy.
Okay, let's jump right into Section 1. What is term insurance? Let's build that foundation.
At its core, it's just a really straightforward financial agreement between you and an insurance company. You pay a fixed amount regularly, that's your premium, and in return, the insurer promises to pay your nominee a lump sum of money if you pass away during the specified policy term. The absolutely crucial thing to remember here, term insurance is pure protection. It's not a savings account, it's not an investment, it is simply a highly effective safety net for the people depending on you.
I absolutely love this analogy from our sources because it really is a light bulb moment. Think of it like paying for a fire extinguisher. You don't buy a fire extinguisher expecting a financial return on it, right? You just need it on the wall to prevent total ruin in an emergency. You spend a relatively tiny amount on the premium, but in return, your family could get a massive payout, like a crore or more, making sure they aren't left financially stranded.
And this comparison brilliantly highlights the difference between term insurance and other products like whole life insurance. Because term insurance is temporary, say lasting 10 to 30 years, and has literally zero cash value component, it gives you massive coverage for a surprisingly low cost. Whole life insurance, though, is permanent. It bundles in a savings component that builds cash value. Because of that added investment feature, whole life premiums are way more expensive up front. So, for pure cost-effective protection, term insurance stands entirely on its own.
So, if it's just pure protection, you're probably wondering, why isn't my savings account enough? Well, that brings us to Section 2, why you actually need this.
If you think a 1 crore payout is gonna be enough forever, you're forgetting about the invisible thief, inflation. To put this into perspective, just think about the real estate market. A standard suburban 2 BHK flat that cost 30 lakhs 15 years ago? Yeah, that could easily be over 1.2 crores today. Your lifestyle grows, your salary rises, and the cost of living just inevitably climbs. That means the real purchasing power of a fixed cover shrinks over time. So your baseline cover needs to be substantial right from day one.
Okay, so how much is actually enough? Let's do some super quick mental math using the rules of 10. First up, you want to aim for a life cover that is at least 10 to 12 times your annual income. Second, take a look at your investments. For every 100 rupees you put into an SIP, you should be spending 10 rupees on a term insurance plan. Let's break that down. If you earn 5 lakhs a year and do a 5,000 rupee monthly SIP, your life cover should be around 50 lakhs and your term premium should be about 500 rupees a month. Simple as that.
And here is an incredibly valuable financial hack we found in the sources. If you have business debts, a home loan, or personal loans, your creditors usually get first claim on your assets. But if you buy your policy under the Married Women's Property Act, or MWP Act, it guarantees that the payout goes strictly to your wife and children. Your creditors absolutely cannot touch it. It is just a brilliant, simple way to build an ironclad wall around your family's money.
All right, now that we've got our baseline defense set up, it's time to upgrade. Let's head into Section 3 and see how you can customize your policy with add-ons, which are also known as riders.
A rider is basically an extension you attach to your base policy for a slightly higher premium, and they are super useful. The accidental death benefit pays out extra in the case of a fatal accident, critical illness, that gives you a lump sum for severe diagnoses like cancer. The premium waiver is a literal lifesaver. If you lose your income due to a disability, your policy just stays active for free. And the income benefit rider actually pays your family a steady annual income for 5 to 10 years, rather than just dropping a single lump sum on them all at once.
Now, there's also a specific feature called a return of premium plan, or TROP. Let's be real, some people just absolutely hate the idea of paying premiums for 30 years and getting zero money back if they survive. If that's you, the return of premium option refunds all the premiums you've paid at the end of the term. But you really need to know that this significantly increases your upfront monthly cost compared to a standard plan. Ultimately, you're trading that pure, low-cost leverage for a guaranteed refund.
Or, going back to our inflation problem earlier, you could choose an increasing term plan. This is an amazing feature where your payout automatically scales up every year, usually by 5 or 10% until it hits a cap. The massive advantage here is that you lock in your health status when you're young. As you age, your salary doubles, maybe you take on a bigger mortgage, while your insurance cover automatically keeps up without you having to take a single new medical test.
Okay, so you know what it is, and you know how to build it. Section 4 brings us to the most critical piece of the whole puzzle. Exactly when should you buy it?
The absolute biggest misconception out there, and honestly, this might surprise you, is that life insurance is something you only need to think about when you hit your 40s or when you finally get married and have kids. But delaying, that is literally the costliest mistake you can make when it comes to term insurance.
What's really fascinating about these numbers is how they visualized risk from the insurer's perspective. Notice how dramatically the relative cost jumps between age 25 and 40. Insurance price your coverage based on mortality risk. Put simply, younger people statistically face fewer health issues. When you buy a policy, the insurer locks in your rate based on your current age, which means every single year you wait to buy, you are permanently driving up your premium for the rest of your life.
Just to put that in perspective for you, a healthy 25-year-old non-smoker could pay less than half of what a 40-year-old pays for the exact same one-core policy. No joke. If you wait until you're 45, you aren't just paying for a policy, you are paying a massive premium penalty for all the years you waited.
So buying in your 20s or early 30s is basically the ultimate financial hack. It guarantees you the lowest possible fixed rates for decades. It secures the longest coverage term so you're protected all the way to retirement. You get much easier underwriting before any of those unexpected lifestyle diseases pop up. And crucially, it protects the compounding value of your absolute peak earning years.
Well, we've covered a ton of ground today. From understanding pure protection to fighting inflation and using those incredibly handy riders. But it all comes down to taking action, knowing that inflation is constantly shrinking the value of money, and knowing that the absolute cost of this protection only goes up with every single birthday cake you eat. I'll leave you with this final provocative thought. Can you truly afford to wait to secure your family's financial future? Thanks so much for joining me on this explainer. Until next time, stay focused and keep learning.